Welcome. We have a lot that we want to be discussing and getting to today. So there are a couple key elements with respect to not only the economy, but some of the different aspects of the world's economy that we're going to be getting to. Then we're going to be discussing some of the different portfolio changes that are being made. Then lastly, we're going to talk about some of the ways that you can benefit from different tax strategies. So that's what we're going to get to today, and I really want to dive into some of those details. Number one, economic and stock market risks. This last week, we saw an incredible amount of change that has occurred in a very short period of time. So one of the elements that we really saw was that Janet Yellen announced that she's going to have an increase in the Treasury General Account. Now, what this is a way that we are working with the borrowing needs of our government. So then she issues bonds based upon the needs that our government has just to fund itself. But what we're seeing is that these are more than expected. So we're issuing more of these bonds than what we had expected and what the Treasury announced just a little while ago. But what the really big news here is that there are two different ways to fund the government. One with short-term bonds and one with a little bit longer-term bonds. The longer-term bonds aren't nearly as what you would call stimulating to our economy, but the short ones are. The short-term bonds definitely do that. And she did not use the short-term bonds to try to pump more money into our system. So that's one of the really key things that we're seeing here, is that there's kind of a lack of liquidity on some of those elements, especially when it comes to what Janet Yellen is doing, at least right now. Now that's going to probably change in the summertime as we get closer to the election, but for now, she's not really working to try to stimulate the economy more. But then we also had Jay Powell speak last week. And I talk about this a lot, and why we're really interested in what he has to say is because of the fact that there's a lot of change that's happening with respect to, well, inflation, bonds themselves, and what that means for the economy. So when we take a look at this, what Jay Powell was talking about is that for over the course of the last about year and a half, 2 years, he's been doing what we call quantitative tightening, where he's been trying to make sure that we're keeping inflation high. But now he's starting to roll off some of those bonds and do what we call really tapering. So that's something that he's going to start removing some of those bonds off the balance sheet, and that again can be actually a little hurtful at times for the economy. But yes, he's been doing that for a while now, and when we reduce the balance sheet, we're not buying as much in bonds from the Treasury. That tends to actually lead to a turn down in the stock market. But we haven't seen that. But here's the thing, the Treasury and the Federal Reserve are making changes. So now what we're starting to see is that with the Federal Reserve, they're not tapering nearly as much, which means they'll be buying some more bonds. So this can also be very helpful for the economy going forward as well. Now, the response to all of this was that we had the dollar go down in price against other currencies. We had the stock market rise, and we also had bonds rise because bond yields started to come down. So that's all actually pretty decent news when we want to be considering that this is going to continue and that this can actually grow our economy. But here's the thing, when we take a look at employment and all those different aspects that we're starting to see, we are definitely in a lead 3 environment. And this is that stagflationary type field where we have a slowing of growth here in the US plus sticky high inflation. Now, other countries are not nearly as dire with stagflation, and some are even growing. And one of those countries that are coming out of a recession or starting to grow is China. Now, I keep saying this over and over, but if China is growing, they're going to take a lot of the emerging markets with them. So even though the US may be slightly overbought, even with the stock market itself, and the bond yields may be oversold, which means bond prices may actually start coming down just a little bit, this all may be temporary. And in fact, if we start actually diving into the details, there may actually be reason that bonds start to rally, bond prices go up, and the stock market itself may continue this as well. So a lot of cross currents here that we're starting to see. But for now, we have had some really good support from our government with respect to what we call liquidity being injected into the markets, and that has actually done very well this year. Now, it doesn't really have to stay, but we are seeing reasons it could. Number 2, portfolio changes. Knowing that there's a lot of cross currents with the economy in general, not only our economy, but the world, we have to be very strategic about what we're adding into the portfolios right now. Yes, it has been working that we can be invested into many different areas of the stock market, including growth and tech stocks, as well as even utilities and some consumer staples. So we have growth that's supposed to be there when we're in good environments, but we're also having consumer staples and utilities that are supposed to be working when the economy is not doing nearly as well. But those are elements that are working right now. But the ones that will be adding into the portfolio more and more really come back down to the inflationary fields, as well as some of the emerging markets and the developing markets. You see, when we take a look at Europe, when we take a look at the emerging markets, especially in Asia, there's been a lot of growth that's happening today that actually hasn't happened over the last couple of years. So they're coming out of a recession, and adding those into the portfolio really starts to add some growth projections where the US may not have nearly as much. So this is ultimately part of the strategy going forward, that we can be filling out and rounding out the different allocations of the portfolio with inflation as well as some international plays. Number 3, wealth management and advanced planning. When it comes to wealth management, there is a lot of key strategies that we talk about here, but I want to continue our topic regarding taxes. Now, one of these aspects regards how we transfer really some investments to others to help minimize taxes. And that is how we can actually be protecting some of your wealth, just based upon the fact that we can lower taxes as well. So when we transfer money, obviously that's going from you to someone else or another entity even. So it may remove it from your usage and it may remove it from your estate, but that may not be all that bad. You see, when we talk about these different elements, there may actually be good reasons to do that. So let's take an example here. One way we can do this is through the interfamily loans. And it's really a common strategy here that allows you to transfer wealth to your family members while minimizing gift and estate taxes. Now, this can be really useful for passing on assets that have been needed for the next generation, but you really want to maintain control over how you are funding and using those assets. Now, another one then would be the grantor retained annuity trust. Now, this is really a technique that allows you to transfer assets to your beneficiaries while retaining the income. So in essence then, think about like a highly appreciated business or highly appreciated stock that we can be pushing into one of these trusts, and then you can still retain income off of there. Another thing that's really helpful here is to use real estate, one that produces some income. And this can actually be a very tax efficient way to pass on the wealth to your loved ones and so get an income stream that you can live off of as well. Now, then we talk about some of the other elements like dynasty trusts, long-term wealth transfer vehicles, and that are skipping multiple generations. So when we take a look at all of those are different ways that we can be working with transfers. Now, then we have the IDGIT sale. Now, what this is called is an intentionally defective grantor trust, and it's really a strategy that involves selling the assets to the trust in exchange for a promissory note. Now, that seems kind of odd that we'd be working with it that way, a promissory note from a trust. But what this does is provide an effective way to transfer assets out of your estate while retaining control over some elements of your assets while reducing the estate tax. So what you're starting to see is that there's a lot of elements to be thinking about here. And especially when we talk about real estate, highly appreciated assets, or others that are income producers that we want to leave for a legacy, or we want to remove out of your own estate for many different reasons. There's many different avenues we can go down. And it's just a matter of what's going to be right for you and your family. Number 4, our second opinion service. I want to remind you of our second opinion service and really think of it like a stress test for your wealth plan. See, we'll take a look at where you're at today, where you want to go in the future, and then see if there's any gaps in your plan that exist. Now, one of 3 things come out from this. Either you're in a good place with your wealth plan, and we'll let you know that. Well, maybe there are just a few changes that you can get taken care of on your own right. Well, obviously we'll let you know that as well. But there may be some larger elements that need to be addressed, and we'll help with some recommendations on how to make that happen. But either way, the goal here is to help you make sure that you have a comprehensive plan that is ready for not only today, but preparing you and your family for tomorrow as well. That's the power of the stress test. And if you would like to go through a stress test, please click the link below and we'd be happy to set up a time to not only talk about where you're at today, but go through that discovery meeting to figure out where you want to be. We've covered a lot today, and as you have questions, feel free to reach out. We'd be happy to talk. Take care.